Hi guys, welcome to AvidForte. Today we're going to discuss a few questions which our users and subscribers have asked us regarding valuation and specifically for the GATE exam. But we will stick to only questions asked in the exam. We will not be discussing concepts or study materials here. So let's begin. The first question which was put forth to us was this: a public utility building of 5,000 square meters was constructed 5 years before. So they are saying there's a building which has a constructed area of 5,000 square meters and it was constructed 5 years back. Now this is a hint that we might be looking at either a depreciation or a sinking fund. We don't know yet, we'll see. The present value of open land in that location is 100 square meters. This means that if you want to buy land at that location today, you'll have to pay 100 rupees per square meter of purchase, and the site is of 1 hectare. Now before I move on further in this question, there are a few things you must always remember for any exam or any even in daily life. You must remember this. Just like 1 kg is 1000 grams, similarly you should know the conversion between acres to square meters, 4046.86, between acres to square yards, 4048, and between hectares to square meters, that is 10,000, and obviously acres to hectares you can do, and there's meter squared to feet squared, 10.764, and between square feet and square yard, 1:9. So these 5 or 6 you should always remember, because these nobody is gonna provide you in the examination, and also as an architect you are expected to know. Now next part of the question, the present construction cost is 2500 rupees per square meters. Okay, fine, that's given. Now if the value of the building is assumed to be depreciating at a constant rate of 6% per annum, so as I had already guessed by looking at the first line, they have given you a depreciation rate. Your value would be going down at this depreciation rate. So for those of you who do not know what practically depreciation is, and since I have been working in this domain professionally for a long time, I can try to explain to you in simple language. Let's say you have an iPhone today and the iPhone is worth 1.5 lakhs. After 2 years, when iPhone 13 has been launched, maybe they're going to launch 14, 15, you want to buy that iPhone. So at that time you might want to sell your phone to some reseller like Amazon, Flipkart. So they would buy your phone at a lower price from you and then do whatever with it in the market. So maybe they're going to pay you 50,000 at that point of time. So your phone was purchased at 1.5 lakhs and you are getting back 50,000. So what is the depreciation that your phone went through? What was the drop in the price of the phone? Similarly, for everything on earth there is depreciation. Get these concepts clear, because tomorrow if you run a business, if you want to save on taxes, you have to show depreciation. It will help you save on taxes also. So these concepts are very, very useful. Billionaires and millionaires use depreciation to pay zero tax. So okay, let's focus on the question now. If the value of the building, so they've given depreciation rate, fine. So now if I multiply 10,000 square meters of land with 100 rupees per square meter price, as on date I would have had to pay 10 lakh rupees to the whoever from whom I am buying that land. So if you want to buy a building, you do not just buy that building, maybe you also have to buy that land. Ideally there might be different terms and conditions, but as of this question, sticking to the academics, we will have to buy both the land and the building. Given it's a freehold, I don't think they have mentioned, they should have mentioned freehold, leasehold. This is a freehold kind of a property. So 10 lakh rupees is the cost of land. Now does the cost of land depreciate? Does land become less usable, more usable? Land is land, yes. The price of land might go up and down in the open market, just like value of stocks go up and down in the market, but land doesn't depreciate, because land itself is 1 billion years old when earth was formed. So you can't calculate depreciation of land, so you have to take that value into account as is. Next you have the rate of construction, which is 2,500 rupees per square meter and 5,000 square meters of constructed area of the building. So if you multiply 5,000 into 25,000, you're gonna get 1.25 into 10 to the power 7, if I am doing the math right. Yes, so you're gonna get 1.25 crores worth of constructed building. I've done the math. I've done it mentally. 5 into 25 is 125, and you have 3 4 5 zeros, so 1.25 into 10 to the power 7. It's done. I've done it. So till this point you can do it mentally. Now then, what would be depreciating? The building would be depreciating. The constructed building or the materials would be depreciating. The value of that material would go down. So they have given a rate of 6% depreciation. So if you now at this point you can do a manual depreciation straight line method, or you can just use the formula 1 minus r whole to the power n. So let's say we use a 1 minus r whole to the power n. So r is 6%, so do not write 1 minus 6, it's 1 minus 0.06. So please be careful, this is one point where people go wrong. And then if you calculate, I think you would get, last time I checked it was something 91 point something lakhs. You can do the math. You add up the 10 lakh rupees for land with the depreciated value of the building, which is 1.25 CR minus whatever has been the depreciation by applying that formula, which I'll definitely put up on the screen, and add up the final values. So you get around, last time I checked it was 1.1 CR of the value of the property. It's a very simple sum, tests a few basic concepts. You are expected to get a few questions of these types in the future exams for GATE. Okay, so what I'll do is I'll move on to the next question now. So the next question asks you that the cost of a building is 10 lakh rupees. Is 10 lakhs? Yes. And the scrap value after how many years? 50 years is 1 lakh rupees. So they're saying the building is priced at 10 lakhs today, and the scrap value after 50 years is gonna be 1 lakh. So remember the phone depreciation example I given you. Similarly, there's a building 50 years. What did I, okay, in the phone depreciation example, let's say in 2 years the value of the phone went from 1.5 lakhs to 50,000. So in 2 years you had a depreciation of 1 lakh. So in every 1 year you had a depreciation of half a lakh or 50,000. Similarly here also, given straight line method, I mean it couldn't get easier. They are not even asking for accelerated depreciation. You are not a chartered accountant. You are not expected to know. You may know, or maybe if you have queries you can ask me, even I know. But otherwise straight line method is very simple, divide by the factor or the number of years. So that would give you 10 lakhs minus 1 lakh is 9 lakh of depreciation, and a 9 lakh depreciation over 50 years. Let's say 50 years is 9 lakhs. So 9 lakh divided by 50 is every year. So how much would that be? 90,000 by 5, 18, 5 is 90. 18,000 depreciation per year. And the options are whatever the options are. Option C has 18,000, that's the answer. See, both the questions I have done it live in front of you without even looking at the options or solving anything. It can be done mentally, and I've done it live, and I'll keep doing things mentally. If you are good at math and mental calculations, you can easily get them done. Yes, also because I work in finance daily on every day, 8 hours a day on finance, and also other work for the remaining 10 hours a day, 16 to 18 hours every day. Maybe my mental maths is fine, but okay, you can also reach that level with practice. Fine. Now they're saying the book value after 10 years. Now to understand book value, just grab a piece of paper. You have this paper. Now first of all you write 10 lakhs. That is year 0, the very day on which you buy that building. It is worth 10 lakh rupees. You've written it on your paper. I asked for a paper. If you had a book, you would have written it down on the book. Now after that, write off a depreciation. Write off in finance means to forgive or give away. Write off a depreciation of 18,000 on that 10 lakhs. You would get 9,82,000 as the resultant. Again next year, write off a depreciation of further 18,000. How much would you? Mental maths. 9,64,000. You have to be good at maths, mental maths at least. So now what is the book value after 2 years? What number have you written on the book? You have written 9,64,000. So that is your book value after 2 years. Imagine doing the same thing for 10 times or 10 years they have asked, right? Yeah, 10 years. So how much would you get? You would have a depreciation written off to the tune of 18,000 into 10, 1.8 lakhs. So you would be left with book value or the value on the book would be 8,20,000, and that is your answer for this question. I have explained it to you, taken maybe 2-3 minutes. You could have easily done it in 5 seconds if you have that mental capacity. If not, fine, take some guidance from somebody and just get it done. These are easy things in the exam. And we'll move on to the next question. So this third question says the maintenance of a building is going to cost you 2 lakh rupees after 10 years, which means, okay, today you start saving, in 10 years you know you'll have to invest 2 lakh rupees for maintenance. The annual sinking fund, rate of sinking fund they have given you is 6%. So you have to save money at the rate of 6% to account for the loss of the value of the property. Now what they have said is, what is the sinking fund value? I'll give you an example of sinking fund first, and if you have even had a cursory glance over the theoretical discussions or the material for valuation, you would have come across this term called sinking fund. The sinking fund concept is such that, let's say you have a business and you want to buy a Ferrari or a Lamborghini after 10-15 years of running your business, a successful one. So what you decide today is that since a Lamborghini is priced starting around 2 crore net, you want to save that amount of money. So you save that amount of money over 10 years and you go to the showroom after 10 years to buy the vehicle. But a Lamborghini is priced at the dollar rate. When I was your age, Indian rupee was 65 against every dollar. Today it's 75, somewhere around 70 to 75 every dollar. So money is gone down, dollars become stronger. So that's why these, gadgets, vehicles, whatever you call them, are priced against the dollar. So after 10 years the money might get weaker, something else might happen. So you have to account for that extra amount of cost which you did not account for today. Maybe at that time Lamborghini is priced at 3 crore. So the extra 1 crore you did not account for, so on that date you can't buy that vehicle. So this is the concept of a sinking fund. Now here you just put the values into the formula. It's 1 r divided by 1 plus r whole to the power n minus 1, simple. It's just the reverse of the other formula. So in that case, when you put the numbers into the formula, you easily get the answer. You get the total sinking fund, and the total sinking fund is what they are looking for. They are not asking for the annual payments or something else. Alright, a small correction in what I said last. So they are looking for the annual sinking fund. You know the total amount of sinking fund is 2 lakhs. How much money would you have to keep in the bank or keep in your accounts? At 6%, that will add up to 2 lakhs at the end of 10 or whatever number of time they have, 10 years, that's it. So that's how you get to the answer. So the next question is even simpler, but it tests you on a very easy concept. They have asked you the cost of a building is 2.5 lakhs and that the scrap value of that building is 10% of the cost, which means if something is priced at 2.5 lakhs, the scrap value at 10% would be 25,000. So the remainder of the value which would be lost if the building completes its life cycle at the end of 20 years would be 2.25 lakhs, because remaining 25,000 added up you get the total amount of 2.5 lakhs. So now that you know what the scrap value is, that is exactly I think what they are asking for, what is the sinking fund. Now you have a scrap value which you would know you would anyways recoup after even the building is demolished, get back the scrap value, but you lose the usable value. So the usable value has to be kept aside. Let's say in future you want to buy a new building of that same amount of money, or you want to refurbish the building to today's level. So if we ignore all inflation or other non-constants, so if you want to be able to refurbish your house at this today's level, you would have to put in 2.25 lakhs, and 25,000 anyway somebody is going to pay you because they are buying the scrap from you. So you will have 2.5 lakhs, so you can pay for that building. So the sinking fund would be the total cost minus the scrap value, so remainder of the cost, the lost usable cost would be the sinking fund that you have to keep aside. Now after that, just the last question which we discussed, annual sinking fund, and yes, in the last question there was a small correction. I assume, because I was not looking at the question paper constantly, I was talking to you, I assumed they are asking for the total sinking fund. That's not the case. They had given you 2 lakhs. They were asking for the annual sinking fund. Anyways, you can easily find that out from the formula. Same formula, same application. They are again asking for annual sinking fund. Same technique you use here also. you will find the annual sinking fund, the same formula, put in the numbers, you get the answer. So we'll move on to the next question. So this is the last question that I have on my bucket list today, because we've come to the end of today's discussion. It's the same question, nothing else, nothing new here. The original cost of a building is 2.5 lakhs and the scrap value is 10%, but not mentioned as 10%, mentioned as 25,000 straight away. So they are not even changing the question or anything in the question, they're just changing the numbers. The concept is the same and you don't have to use a head, you just have to put in the values and get the answer. But instead of 10 years, they've put in 55 years. Big deal. 2.25 lakhs divided by 55 would give you whatever the number is. That's going to be the answer to this question. So after this short introduction to valuation that I wanted to share with you, I would still caution you that valuation might be easy, but comes with a few caveats. That is, you have to know a few concepts other than depreciation, just like total the recurring deposits, simple interest, compound interest, different kinds of concepts. There are 4 or 5 different concepts. I generally tell my clients about 6 or 7 formulae that they have to understand, and I give them the logic behind it. Comes directly from the infinite series in maths. So it's pretty easy, but you have to be very careful with your preparation. Then valuation can be easily attempted, and if they give you theoretical questions, you also have to brace yourselves for any theoretical questions that comes your way. Now finally, at AvidForte, as we always tell you, we share your concerns with equal consideration as if it's our own concern. You can come up to us for any training related material, for GATE, for any other exam, and then you can also come to us for any skill development, and then your resume, portfolio, SOPs, internships, jobs, etc. We will always be there for you. I'll put down my contact details in the description below, and some other useful videos will always be linked above, so you can check them out, and hopefully you've liked our presentation today. See you in the next video. Bye guys.